So as I say, who knows? I can't tell the future. I'm not trying to predict it. What I'm saying is let's be prepared for the good, the bad, and the unforeseen. If you have your cash, one of the things that Buffett is famous for is capturing his cash and not buying anything. No stock, no house. In fact, he's not really into real estate at all. But let's understand, he captures the cash and waits for an opportunity to fall in his lap. And that's what he studies every day. He suits up to go to the office, literally suits up in his old Cadillac, it was an old truck, to study opportunities.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, we know markets in the U.S. are in flummox right now. Are we becoming another Japan? And hey, perhaps Japan is where you should be investing. That's where Warren Buffett recently bought a whole bunch of stocks. Maybe it's the place to go. John Grace is with us now. John, it's great to have you back on the show. And so tell us, what can we learn from Japan?
Well, it's a great question, Kerry, and good to see you again. And what we're trying to do is, people will get lost, I think, in saying, well, it has to be positive. Ever been you say something negative. But my best example is, geez, you probably drive your car with GPS on it, right? And it tells you objects on the road ahead or a speed trap ahead. Is that bad news? No. What do? You do what I do. We sit up, we're more alert, and we don't want to hit anything. So what we're talking about here is maybe we can, maybe we now understand after COVID that we're drinking the same water, we're breathing the same air, we're flying the same airplanes. And maybe we can turn on our GPS system, put on the headlights, the high beams, and see what's around the road ahead. So what's so fascinating is I think to a person, we all agreed back in the late 80s, Japan was going to be number one in gross domestic product. We were okay with that, right? They got the sun and the flag, they own everything, they're fine. Go ahead. But that did not happen. In fact, what we can see is approximately 12/29/89. That's when first the Japanese stock market hit darn close to 40,000. And then in about 18 months or so, Kerry, the Japanese stock market measured by the Nikkei 225, that would be the equivalent of the S&P 500, dropped 80%. 80%. So $1 million went to 200,000. Okay. A year later, Japanese real estate dropped 70%. I mean, so that means $1 million went to 300,000. So you used to have 2 million. Now at the bottom or so, you have a total of about 500,000. And here's the trick question. And I emphasize, Kerry, it's a trick question because you don't have to study this to get the answer correct. If you follow the formula, when you hear it's a trick question, that's a clue, right? So here's the trick question. Which do you think has come back to even? Has it been the Japanese stock market or the Japanese real estate market?
I don't think either has.
Neither. Go to the head of the class. Financial survival. Neither. Imagine it's over 30 years later, and neither your stocks nor your real estate you had 30, 34 years ago are back to their highs, and now you're 34 years older. Now just imagine that for a minute. Now, the Nikkei has recovered to some extent. Last I looked, it was around 33,000, but the peak was at 39,000. What does that mean? You're still about, 5-10% below the high water mark? And that's assuming what? You didn't sell one share. You didn't need any money over the last 33, 34 years. Where is that true for anyone, okay? And then now we see with real estate, no, neither the real estate market nor the stock market has come back to their high water marks. In fact, now we can see evidence that there are 11 million homes in Japan that are completely vacant. That's hard to imagine, but that's the way it is. And from the source that I found, suggests that the Japanese could be on the trajectory of tripling that number to 33 million, and they could all be vacant out of a total of 62 million homes for a population of about 127 million people. And let's understand part of what's interesting about Japan. They work hard. They're known to be very intelligent. They're fastidious. They typically tend to be polite. And they have the highest life expectancy at 84.8. By the way, we're at 77. That's an interesting number for us to watch. Why is it interesting? Because I would submit that the real estate boom that we've so enjoyed here on this side of the pond is primarily due to baby boomers, 76 million people strong, born between 1946 and 1964. But 77 is important because 77 is the average age of death in America for most of us. 77, almost 85 in Japan, higher than 80 in the UK and Canada, much lower than 80 for the US of A. So here comes 76 million people that came into this equation called the United States of America. And I don't know if it was an irrational exuberance or what it was, but when you have 76 million people come into the equation, it stands to reason you have a lot of demand for a lot of things. So here's the question. What happens when 76 million people go to heaven? Well, if we look at Japan and we look at what happened after the Great Depression here in the United States of America, where New York real estate took 4 decades to come back to even, the life expectancy, if we were adults at that time, Kerry, was, I think, 57. So what does that say? Your real estate went down 70%. Your stocks went down 80%. Stocks took 25 years to get back to even. New York real estate, always the capital of capitalism, right? Took 4 decades to get back to even. Neither the real estate holdings nor the stock market came back to their high water mark while you were still here. So I suspect a lot of people died with regret. And now we see this pattern playing off in real life right before our eyes in Japan. Could it be that we're going to follow their example? Well, I think that is very possible. Again, why 77? We've been told what? It's about location, inventory, and interest rates. Well, if it was so important about interest rates, why were baby boomers standing in line in the early 80s to buy a house at 16%? Maybe it's not so much about interest rates. It's about studying, something we don't do, the buying and selling behavior based on age. So 77 is the average age of death in America. 78 happens to be the average age most Americans sell. And if you look at any block across the country, probably 4 to 5 homes on each block are owned by boomers. I'm just saying let's get ready for something we have not seen before. It's completely unprecedented, but it would not surprise me in the environment where people dying outpace people buying, that prices and rents do what you've not seen them do before. They go down and they may stay down. So this might be a good time to look for bargains, as Buffett is famous for. It also might be a good time to take some chips off the table, right? Because you count the equity as cash, but it really doesn't count as cash until what? You cash the checks. Kind of like going fishing. If I tell you about the fish that got away, you don't want to hear it. Show me the fish, eat the fish. That's a better story than telling me about the one that got away. So yeah, these are interesting times and they're completely unprecedented.
So is it strictly demographic here, or is it, is there more at play here?
There's always more in place. Yeah, there's all, but I would say that the majority of us, I have a friend of mine who runs a big real estate company. He says, John, I've been in the business 40 years. I've seen everything. And I'm like, what you have seen is what we've all participated in. That's boomers coming into the equation, driving prices to new highs. You have not ever seen 76 million people go to heaven. That's a whole new environment. So do not tell me like you did about COVID. Oh, we'll be back to normal just in a couple of months. No, we're not. Don't tell me that it's going to do what it's done, because we're in completely uncharted, unprecedented territory. Again, if the demand, 76 million people out of 330 million or so in the country, go to heaven, and the supply of homes across the country remain the same, they're not going anywhere, what do you think prices and rents are going to do? I submit that they're going to do what they did after the Great Depression. Prices and rents went down after the Great Depression. So as I say, who knows? I can't tell the future. I'm not trying to predict it. What I'm saying is let's be prepared for the good, the bad, and the unforeseen. If you have your cash, one of the things that Buffett is famous for is capturing his cash and not buying anything. No stock, no house. In fact, he's not really into real estate at all. But let's understand, he captures the cash and waits for an opportunity to fall in his lap. And that's what he studies every day. He suits up to go to the office, literally suits up in his old Cadillac, it was an old truck, to study opportunities. And I love his line that the bad news is an investor's best friend. Bad news is an investor's best friend. So again, if we're trying to hold on to the equity and prices are going down and they may not recover while you're still here, you wish you had gotten your cash, like going to Vegas, take the chips off the table and come back for another game. Let's catch the next wave.
No doubt. So you're basically telling your clients, sell.
Well, I'm saying here's what we think is going to happen. Here's what we think is happening right now. And for those who have excess real estate, what we're saying is if you don't love it, leave it. All right. If you don't love it and have to have it, get your cash. I've got a friend of mine with 12 properties. I said this just to her over the weekend. Sell half of them. I don't know what's going to happen, but you've got no less than $12 million lined up in 12 different properties, right? They're all in Southern California. It's called earthquake country. If you have $12 million in Amgen, which is right up the street here, I would say the same thing. Take some chips off the table. Don't leave it all in one spot. That is not diversification. The asset type is the same. All right. $12 million, and that's probably a modest estimate, is a whole lot of money. Take $6 million off the table while you can at these high water marks and figure out what you're going to do with the cash sometime in the future. But I would let's look at it this way. Don't sell high and buy high, right? Keep your capital. If I'm talking to young people, and they say, look, we've got the down payment. We want to buy a house. I'll say, look, well, with God, if you're okay with prices dropping 50%, our research team suggests that real estate prices in the US of A will revert back to their values in 2012. So on average, that might be as low as 14% in Nashville, as high as 70% in Phoenix. But on average across the country, a reduction of about 50% from here. Again, no one can tell the future. But if you've got your cash, you don't really give so much. You don't give a hoot what happens to that value because your cash is in your pocket where you can watch the movie and you can, as I say, catch the next wave as it shows itself up. But once you have the equity and you see the decline and you don't see the recovery, it's depressing as hell.
Yeah, it could definitely ruin your day or even your retirement, John.
100%. It could ruin the rest of your life. I submit that's part of what drives me, studying what happened during the Depression. As I say, age of death was 58. You had to be an adult to have $1 million anywhere, right? But not the stocks and the real estate in New York didn't come back while you were here. No, I want you to have the money in your pocket, not on a statement if you think it's cash. And then, as I say, you can catch the next wave. When it comes to real estate, we're suggesting that people look outside of residential, look at warehouses, look at medical properties, look at infrastructure, look at these places that the demand's not, I sent my wife a Christmas gift. I counted all the little stickers from the different places where it was warehoused from China. I counted over 20. Well, I would say to you, that's a good place to look at investment opportunities where there's always something coming through this. Somebody's paying for it to be shipped. Own the warehouse, own the distributor gas facility, own the medical facility where we're standing in line waiting to see a doctor. 10,000 people a day are turning 65 through 2030. So let's look at where the wave is headed as opposed to where the wave is crested.
Mm-hmm. All right. So, and how confident do you feel about this?
Well, I love the question. It's close to the question where people say, well, when's this going to happen? I'm like, I can't. It's not about the prediction. It's all about the preparation. And I'm going back again to the research team because that's what they do. And in 06, 07, they suggested that real estate prices were likely to drop by 40% in this country. No one's making that forecast. From what I can see, on average, the decline was about 34% across the country. That's pretty close to 40. They're the ones who are saying, did research that right now, be not surprised to see prices drop 50%. And I don't know how we're going to miss this. As I say, we've only seen 76 million people show up. What happens when 76 million disappear?
We got a lot of illegal aliens who are hopefully going to take their place, right?
Well, when it comes to that subject, and this comes from the research team, and understand that the majority of the the folks in the room, financial advisors, really from around the world, the ones who are from the U.S. are generally Republican. And the research team looked at that situation. And what they looked at, many people were surprised for them to not look at it from an emotional standpoint, but look at it from a standpoint of, is it a net gain or a net loss? And what they found was it was a net gain. In other words, whether you were legal or illegal, you when you come here, you put a lot of money into Social Security and into the taxes, property taxes, sales taxes. Then you get married and you have kids. Where are you going to go? So what we're saying, we don't have enough people. No country is replicating itself outside of India, which means we have more people dying than we have children being born. And that was happening before COVID. It got exacerbated by COVID. So I'm saying that, if you look at Canada as an example, I believe they brought in over 1 million immigrants last year. They're the only ones with an open door, and they'll take everybody. But and understand, they often get the best and the brightest. But when you have an attitude that, we're just fine and we don't need anybody, well, you're gonna. That's when you find that you. What did I just hear? A brand new Starbucks closed in Northern California. Just heard this morning from a real estate group, and it closed because they couldn't find people to pay $20 an hour. We don't have enough people here. So whether you like them or not, and remember the reason that we're younger than Japan is because of our immigrants. They tend to have more children. They tend to have children. The rest of us, not so much. So we just need more people. And again, it doesn't matter as far as I'm concerned. We prefer for people to be legal, but at the end of the day, it's a net benefit to the country, legal or illegal.
I don't disagree with you at all. I just think it needs to be more controlled, regulated.
Yeah, it should be a process.
Process rather than
free process. Yeah. Exactly.
Free for all over the border just doesn't work.
No.
Bad things can happen as a result, and it's got to be orderly, much like it was the turn of the century. No one in the country since the Native Americans are here and the Mayflower pulled up, nobody's ever been thrilled about immigration, right?
Yeah.
Very few.
We usually go, my group got here, so raise the drawbridge, right? That's how.
Yeah, right. That's it. But the fact is, when it's done correctly and not with ulterior motives, but actually for the good of the country and the good of the people coming here, it's always been a net positive. Always.
Everybody wins.
Yeah. So let's go back to those days. All right. So after the demographic cliff coming, and it's got all sorts of unintended consequences. Is AI and is robotics gonna get us out of this, John?
Well, that's the wild card. I mean, most of us don't really quite understand, kind of like the internet when back in the 80s when that was new. What is this? How's it work? Well, same story here. Yeah. But, as a friend of mine was saying, again, just this morning at another business call, this gentleman said he used to have 18 people work for him. And now he can do him with technology and his own, and he's 85, his own capabilities. He doesn't need those 18 people. He can get it all done himself. So yeah, it's going to be very interesting how this plays out. But that's also why we want to keep our eyes on the ball in terms of, let's see where opportunity can present itself and insert that opportunity.
Totally agreeing on that. The implications of AI are just really completely not understood and appreciated at this point. So, like you said, there are sectors that you do like, sectors that you don't. What is your number one sector looking ahead that you think, regardless what happens demographically, it's going to be a winner?
Well, okay. For investors outside of real estate, we like, first and foremost, that all the positions are actively managed. If we look at most mutual funds, particularly in 2008, where the market was off 37%, the majority of mutual funds stayed passive. That means they were 5% cash, 95% invested. And when the market was off 37%, a lot of the no-load funds that so many of so many experts have said, put all your money in it and forget it. We're off over 40%. And by the way, they often took 4 to 5 years to get back to even. As opposed to a passive position, we like active management, which for some clients, the portfolio for them, if that was right for them, started at 5% and may have ended '08 up to 100% cash. So think of a Karate Kid, wax on, wax off. In '08, you wanted to wax off. You wanted to get out of shares and into cash. And you need someone or some system that can systematically pull that funk for you, just let it move, not in a bulk necessarily, but looking at your account every day, asking the question, is it risk on or risk off? In '08, you wanted risk off. Starting March 9th, 2009, you wanted risk on because we're off to the races, right? So that way, maybe the account, as I say, started '08, 5% cash, went to 40, 50, in some cases got to 100% cash. In those scenarios, you can see the evidence that those accounts that work like that might have been off less than 20%. Well, that's better than 37 or 40 or more, okay? And then as the coast became clear that it's off to the races again, maybe you have a system designed to move your money on your behalf out of cash back into shares, risky assets, so that now you're 95% invested, 5% cash. That's the combination that we like, that we think, we've seen it hold up better in '08 and in 2022, as opposed to the markets just last year being off 20 to 30. If your account was off, let's say 10 or less, you can go, well, I don't like losing $100,000 on my million, 10% of a million, but I'd rather it be 100,000 as opposed to it be the market at 20% or 30%. That would be a minus of what? 2 to 300,000. So what do they say? When you find yourself in a ditch, stop digging. Let's stop digging at 10% as opposed to watching the account drop 20 to 30%, because then we don't need a Hail Mary pass just to get back to even. What else we like are private equity and private credit positions. And for retail investors, that's relatively new. Those kind of areas of investing, the institutions and endowments have been in for over 40 years. And up until recently, the only folks who had the ability to take a position had to be accredited, had to have $1 million outside of the house to be able to talk to them about such a position. Well, those rules are changing. And some of these positions that, as I say, the institutions and endowments have been now opening up to retail investors so that you can, you mentioned Warren Buffett, he's famous for taking huge positions in public companies. There's far more private companies than there are public companies in the US today. And if it is the case that there's a pool where you can invest in 12 or 14 different private companies that are trying to do well and have done well, we find, for example, that the 2022, those positions, the ones that we've been monitoring and recommending, had pretty good yields and low to mid double-digit returns. We think that will continue. We called these positions back in 2018, 2019. We thought they would be recession resistant. That was a word nobody was using back then. And then so far, that's exactly what they have proven to be, recession resistant. And that's the point. We want to limit our losses where we can and see some gains in other positions. But that means we have to be diversified in more things than the securities industry has told everybody you're diversified, Kerry, 60-40, limbic stocks, bonds, bond stocks, you're well diversified. Well, if we look at Yale as an example, I count 7 legs underneath their portfolio stool. So clearly, I submit that we can't do what Yale does, but maybe we can learn from some of the best and brightest. And by the way, the last time I looked, Yale's endowment exposure to U.S. stocks was all of 3%, not 30, not 70%, 3%. That's not a suggestion. It's just, notice their exposure to traditional assets is a lot less than one would think. And they have, as I say, more legs underneath their portfolio stool. So maybe we can learn how to do some of the things that major endowments have done in our own portfolio.
All right, John, really appreciate you coming on, talking about this. I think it's really important. It's not being paid enough attention to, for sure. Hey, where do we find you at these days on the internet? How do we connect with you?
We're at westlakefinancialadvisors.com, Investors Advantage. Happy to answer questions and see how some of these things make sense for folks. And one of the questions that we like to help people answer is not, are you conservative, moderate, or aggressive? I don't understand the question. You don't understand the answer. So what the heck are we talking about? How about we dig deeper and have you answer a series of questions? And that includes, what kind of loss can you accept? Is it 8%? Is it 80%? You tell me how bad it gets before you pull out your hair. But you want to see how your portfolio did. We were working with the referral just last week. This lady's been to 70 countries. She's well into her mid-70s. And when we back test to look at her portfolio in 08, if she held the same positions in 08 as she did when we reviewed her portfolio at the time, while the market was off 37%, her account was off 70%. That's huge. So yeah, most people don't look to see how bad it got, which I submit leaves you open to it doing something like that again or worse. So maybe we should learn from the past, not just repeat it, and see what kind of losses we've experienced. And then the question becomes, what kind of loss are we okay with? And is it possible to put a portfolio together that might perform within your loss parameters, as opposed to me telling you, hey, stocks for a long haul. That's what it does. You got some more money, don't you?
Yeah, exactly. Couldn't agree with you more. And those one decision stocks from the Nifty 50 during the 70s, we all know that wound up with a trail of tears. And no doubt any of these little investment concepts du jour will eventually look great while they're working, and eventually they will fail. And that's where you wind up. Hey, if you got a question for John, myself, email kl@kerrylutz.com, and make sure you go over to financialsurvivalnetwork.com. John's site is in the show notes for this interview. While you're there, sign up for your free newsletter. John, great having you on as always. Thanks for that insightful recitation there. It really opened my eyes.
My pleasure, Kerry. Look forward to seeing you next time.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.